Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and we're joined today with, once again, our very own TraderStef, senior contributing editor here at Crush the Street, a valuable member of our team. We just did an update with her last week, we released, and we have her on once again to continue to cover the coronavirus, what is going on in the markets, the crash, the plunge that we are seeing, and what is going on with metals. And we're even going to talk about Bitcoin in this current environment. But as her bio would show, she began her career in 1996, a career spanning 14 years within the New York City investment banking industry. She acquired a diverse skill set in human resourcing, technology, and communications, training, education, and development, business analyst, and global risk management. She began investing in precious metals in 1999 while following market trends post-dot-com bubble and 9/11. She left the banking industry after 5 years in global risk management at Citigroup. As an independent investor trader, she began cutting her teeth in technical analysis in live trading room venues. And she's also developed and hosted a precious metals hour, fusion analyst webinar, specializing in gold, silver, and mining equities. And without any further ado, TraderStef is on the line. And I want to remind everyone to get our A to Z report on what is going on with the coronavirus. Visit crushthestreet.com/virus for this report. TraderStef, thanks for coming on Crush the Street with me.
Hey, Ken, good morning.
Good morning. Coronavirus has been officially called a pandemic, Steph, and I would start off with this. You know, in 2009, H1N1 killed 284,000 people. We did not see conferences shut down. The NBA was not canceling their season. We didn't have nationwide quarantines and school closures. We're still a little bit early in the stage on this, but is there a larger fear that governments are preparing for in the ramp-up phase of this coronavirus?
Yeah, I kind of think we're there, and I think for a lot of folks who are just living their lives, maybe have a 9 to 5, you got kids, you run around doing your thing. And I think to the majority of those people, it came on suddenly. But for us, we follow the financial world and we're exposed to the news on a daily basis, and we have to follow it. We really don't have a choice for many reasons. It came onto them very suddenly, and I've noticed that with my neighbors. I tried to mention something to them several weeks ago, and as of yesterday, as you mentioned, it's officially a pandemic. But it was for several weeks, and as we discussed in the last interview, it was spreading for 6 weeks. So the WHO finally came out and hit the panic button. It's a little nutty out there, as well as the markets, and we're going to get to that. But now we have a full travel ban from Europe for 30 days. That's a huge deal. So let me resume my screen sharing here. And the reason that this happened is not just that it started in China, but we're in the age of modern travel. And this thing spread by airplanes. And I don't know where this graphic came from, but it's kind of funny. The situation is not funny at all, but that's pretty much what happened. And to think that you're going to stop it in the modern age, no matter what you do, I mean, once it's out, and it seeds and it spreads, and you're done. You're stuck. So I think it was kind of prophetic. Something we mentioned last week was what David Collins said. He's the professor of organic chemistry at Cornell University. And he said, everybody is canceling everything. Mind you, this was February 28th. He said, everybody's canceling everything. Flights, meetings, conferences. Nobody wants to be the chump that held the meeting at death. So the global economy and supply chains are breaking down at breathtaking speeds. Now, yesterday on Twitter, I noticed that what was, what do they call it when it's trending? Cancel everything was trending. You know, you can't make this stuff up. But for anyone that didn't get to read the first article I did, it was on January 21st. There it is. You can look it up. Go read it. But back on February 28th, by the way, we had Dr. Mike Ryan, who's the executive director of WHO. And what he said then was, he said, quote, "This is a reality check for every government on the planet. Wake up, get ready. This virus may be on its way and you need to be ready. You have a duty to the world to be ready." So anyone that says that the WHO was behind the curve, not really. They were hinting of what was going on back actually in mid-February, but I just pulled that quote for an example. And then the director of the WHO, I think his name's Tedros, T-E-D-R-O-S. Yesterday, what he said when they announced the pandemic, as you know, officially, he said that the past 2 weeks, the number of cases outside China has increased 13-fold, and the number of countries has tripled. So that's deeply concerning of the spread and the severity. That's important. And by the alarming levels of inaction, you know, he said he scolded some of the world leaders for failing to act quickly or drastically enough to, you know, work on the containment. Now, 81 countries as of yesterday are infected. There's no confirmed cases in 57 countries. Well, 57 countries have 10 or less, but 81 countries have no confirmed cases. I'm sorry. But everybody else, you know, it's a pandemic. So there's some countries are struggling with a lack of capacity, some with a lack of resources, and some are struggling with a lack of resolve. So let's pull up the map of the United States. And this is what it looks like if you take from January 14th and you just look at every Tuesday. And this is how it has grown through the country. It's exponential. So we're a few days behind here. And in the initial article I wrote on January 21st, just for the heck of it, I threw in a video clip of the movie Contagion. And if you hadn't seen it, it's spot on. Here we go.
It was a groundbreaking ceremony for a new factory.
Did she mention seeing anyone who was sick? Anyone on a plane, the airport?
No, she said she was jet lagged.
The average person touches their face 3 to 5 times every waking minute. In between, we're touching doorknobs, water fountains, and each other.
Beth. Mom? No, go up to your room, honey.
So we have a virus with no treatment protocol and no vaccine at this time.
You had a seizure this morning, Beth.
She had a history of seizures,
No.
allergies.
As of last night, there are 32 cases.
Fortunately, she did die.
Right. He says, can I go talk to her?
Mr. Amoff, your wife is dead.
What are you talking about?
Okay.
What happened to her? What happened to her?
Is there any way someone could weaponize the bird flu? Is that what we're looking at?
Someone doesn't have to weaponize the bird flu. The birds are doing that.
Watch this. It's transmission, so we just need to know which direction.
On day 1, there were 2 people, and then 4, and then 16. In 3 months, it's 1 billion. That's where we're headed.
They're calling out the National Guard. They're moving the president underground.
People will panic.
Get away!
It will tip over.
The truth is being kept from the world.
Cook your samples, destroy everything.
Hello. I need you to get me the names of everyone who serviced this room. It's an emergency.
You can't panic now.
I know.
I'm gonna get you home.
I got people too, Dr. Cheever. We all do.
Don't talk to anyone. Don't touch anyone. Stay away from other people.
So they're calling in the United States, they've coined this social distancing. It's basically self-quarantine the best you can. So let's bring up a few questions I think everyone has. There's
So,
the Johns
Steph,
Hopkins.
I mean, let me just jump in right there. I mean,
Sure.
yeah, and I think that's what you're going to get to. But really, is this, how much different is this from H1N1, the previous SARS, some of these other pandemics? You know, is this being overblown, or is there something underneath this that is more problematic that we all should be aware of and be that much more concerned about?
Absolutely. Let's put this into perspective. First of all, we've got to address what's going on globally on that map before we can compare it to what's going on with, say, the influenza. I remember looking at this map a couple months ago, and there was just one big red dot in China. So as you can see now how it's spreading. What you have to consider here is the case fatality rate. And the problem that's going on out there is they're putting the wrong rate. And folks are taking the total confirmed cases and they're dividing the deaths into total confirmed cases. That's not how it works. And you'll notice that on the Johns Hopkins map, over on the right side, they specifically break down the total recovered by the deaths. So that's the numbers that you use to do the calculation. So you add the total deaths to the total recovered. Recovered is someone who's been, cured, which you really never are. You went into the hospital, your symptoms varied all the way up to being incubated, and you either walked out of the hospital and recovered, or you went out on a gurney and you were dead. So you add those two numbers together. Then you divide, you find out what that percentage is between the total deaths and that number you just added together, and that gives you the case fatality rate. Now, there's a process as this wave is going where that number is going to change, and finally it's going to come to a median. So China, the whole world right now, if you do the math, is at 6.5 case fatality rate. If you do China right now, if you believe their numbers, it's now at 5%. There was a time it was up in the 60 to 70% range. South Korea right now is about halfway through their wave, I'm estimating. They're at 16.5. Italy is in the throes of the very beginning. They're completely overwhelmed. They're at 44%. The USA, we're just getting started. We're at 82%. So if I just click on the US, and you can see how it pops up, we got 38 deaths and 8 recovered. You add that together, you get 46. So what's the 38 of 46? That comes to 82%. That's the case fatality rate at this point in time. So how does this compare to other things? Let's go back to the 1918 pandemic, because back then it's estimated that the CFR rate was 10 to 20%. So roughly 1/3 of the world population got infected. So that CFR rate of 10 to 20% with the given population, that means 3 to 6% of the entire world passed away. Now, the numbers of infection rates range from 40 to 100 million, depending on which numbers you look at. So it probably killed more people than the Black Death. Now, how does that compare to what's going on right now? Well, there's a thing called the R0 value that's really important, because as you can see on this chart, this is a screenshot from a CNBC interview. The R0 value tells you how many people you're probably going to infect when you're infected. And you don't have to be showing symptoms to infect someone. You look at the seasonal flu, it's down at 1.28. That's one person, 1 in a quarter people you're going to infect. This COVID-19 is anywhere between 4 and 7 people. That's why it multiplies. There's only one disease out there that was more virulent. That was measles. And that's where it stands right now. So according to the WHO, the seasonal flu generally kills less than 1% of infected. And according to the National Institute of Allergy and Infectious Diseases, that number is 1/10 of 1%. So look, this is a brand new virus. It's a completely naive population on the planet. Everybody's infectable. There's no vaccine. It has an R0 of 4 to 7, which is extremely virulent. And there's a very high potential for a CFR rate of somewhere between 10 to 20% when all is said and done. So that is the issue. And if we go to, I like Italy because it's a Western nation, and that will probably be a pretty good something to compare what we'll probably end up going through. And when you look at this chart where we're comparing the US to Italy, where we are today, and when Italy shut down their schools, we got like a few more days where we may be getting to some nationwide stuff. It could get pretty ugly. And there is a thread that you have to read. And it's by a guy who has a contact at an Italian hospital that talks about the resource problem. We could spend a lot of time on that. I don't want to take up that time. But we've had our first quarantine in the United States. And that is New Rochelle, New York. It's a hot spot. They sent in a National Guard, and that's 1 square mile. So they're trying to contain this there. I think the next spot is going to be somewhere in Washington in the Seattle area. So it's getting a little bit weird, and you need to be mentally prepared for what it's going to bring.
Steph, I'd like to touch on something you mentioned in the previous interview, talking about the second wave of the coronavirus. How does that play into, you know, the developments over the last week? I mean, has your thoughts on that evolved in terms of what we are likely to see happen as we go into the spring and the summer and then into the fall once again?
Yeah, and I want everyone to keep in mind that the information I'm providing you is not my opinion. Any of this. You know, I'm just pulling it from the sources that are out there. And the only thing I'm trying to rectify is the misunderstanding of what the case fatality rate is. And with historically flus like this, influenza in particular, any pandemic, there's generally 3 waves. There's the first wave. It's like, you know, the introduction. This is what to expect. And then it'll kind of calm down a little bit in the summer because of weather patterns. But as you can see, it's starting to pop up down in South America where it's summer. So that's not necessarily a given. It really depends on your immediate environment, room temperature, conditions, surfaces. You know, there's a lot of variables. But then there's a second wave. And that generally occurs in the fall, which is usually, it comes back with a vengeance. It's usually worse. And then there'll be a third wave that won't be so bad next winter and early spring. But keep in mind, by that time, there'll probably be a vaccine. And the human body will begin developing antibodies to fight it off. So just like with the influenza, it actually becomes less virulent as the years go by because it'll become something seasonal, just like influenza. And it won't be so bad. So that's why next year, this time, it may return, but won't be as bad as it would say in the second wave this coming fall.
So literally, as we're doing this interview, the market opened and we have another 7% down day, and market circuit breakers were triggered. So obviously, the markets were spooked once again by this virus. The Trump administration, Trump banned travel to Europe for 30 days. And all of this that we're talking about is really setting in. This has been different than what we've seen in the past, Steph, with bad news not really being bad news for the market. The market really believes this panic. And I think before we get there, though, we want to talk about oil. Let's talk about that a little bit. I mean, my goodness, what a perfect storm of events, that the market is dealing with. A supply glut, an oil war between Saudi Arabia and Russia, combined with a collapse of demand for oil with no travel. The economy is basically coming to a grind. Give us a little bit of background on this. I know you wrote an article on Crush the Street, which people can visit. We have that up on the screen here. So please take it away, Steph.
Yeah, well, back on March 1st, Vladimir, the Grand Poopa in Russia, I think now he's going to be, permanently the president until the late 2020s. They're pushing some legislation through over there. But back on March 1st, at that time, oil was $45 a barrel. And there was talk among the OPEC Plus, which, they're trying to bring in more people into OPEC. And Vladimir said $45 a barrel was fine, that Russia was prepared for any adverse pandemic effect on price. And he didn't agree that there needed to be any cuts in production because it wouldn't revive demand in the current environment. And OPEC wanted to cut production. And some analysts speculate that Russia's initial decision to not cut was retaliation for the U.S. meddling in the politics of the Nord Stream pipeline between Russia and Germany. So Saudi Arabia fired back on Sunday, March 8th, and they reduced the price that they were charging China by $7 a barrel and increased their output by 12 million barrels a day in an already oversupplied market, right? And then Moscow, came right back and said, okay, we're going to see on that. We're going to do 500,000 more barrels per day, which put their production at 11.8 million barrels per day and puts them in record territory. And when the market opened that Sunday night, oil plunged 30%. When we look at the numbers, the largest one-day declines, it's up there with number 2 on the list. So that was a pretty hefty clobbering that it got. I'm going to throw the chart up here on oil, and I like to do the light sweet because, it's the best crude out there. It's basically Saudi oil. It doesn't need much refining. It's the standard. And right now we're sitting at, well, it's delayed in the markets. The markets are open, but I'm looking at $30.63 per barrel. Now, keep in mind, the consumer might enjoy the low prices at the pump in the near term right now, but the overall impact from the stock market plunge, which is now in bear territory, the global slowdown, and now we got the fear of public places, it's going to force the consumer into hiding, and the service sector is going to get hit the hardest. I mean, think that through. If we don't have people going to sports events, all those service vendors are not making any money either. So, just across the board, think that through. So the consumer has been the last leg holding up the economy. And now it's, the consumer is being threatened simultaneously across multiple fronts. So it's just not looking good. I really don't have anything good to say about what this collapse in the oil price is going to do.
Steph, let me throw something at you. Obviously the U.S. has benefited from higher oil prices. How exposed is the U.S. In addition to everything else, right, with this crash in oil? The companies, the shale oil, the U.S. became the #1 producer. Just a big deal. So what is the implication on this in addition to, the overall recovery the overall crash that we're seeing? I mean, how much of a leveraged impact is this going to have on the U.S.?
That's a really good question because it ties in to the next topic. It's definitely related.
Let's move right into it. I mean,
yeah.
and the repo situation has been almost in a rear view mirror, but we've talked about it being a sign of the instability, this emergency injection of repo buying, this bailout, right? And so take it away. Let's talk about this repo situation and then, where we are with oil.
Yeah, just briefly, if you don't know what a repo is, the Fed says, yeah, we'll take whatever you got, say treasuries, as collateral, and we're going to lend you a bunch of cash at a certain interest rate under the agreement that we're gonna, we'll be able to buy things back. So it's basically taking collateral for money that they need up front because there's a lack of liquidity and a credit crisis brewing somewhere. And as you can see, it's getting bigger and bigger and bigger. And how does that relate to oil? Well, a lot of companies that were doing fracking and oil drilling, because the United States became the #1 producer and we became a net exporter in oil, which is in that article about the oil war. You can go look that up. But a lot of companies borrowed a lot of money on really cheap interest rates and they were in a lot of debt. So now that they're getting hit with this low oil price, the majority of those producers are not making a profit below 30 bucks, 31 bucks. I don't want to stick to pennies. That's crazy. But let's just say 30, 31 bucks. Anything below that's a problem. But even then, at that price point, there are a bunch of companies that are hurting and they're going to need some cash and they're going to need some liquidity taken care of. And Jim Rickards brought that up because there was an article written by Chris Whalen, who's an analyst in the banking industry, very well respected, was all over the place during the 2008 financial crisis, in the media anyway. And the biggest market problem right now is not interest rates. The Fed can cut, it ain't gonna matter. The problem is liquidity. And the Fed does not understand the difference. I kind of think they do a little bit, but they're playing catch up. So that's why repo is going through the roof at this moment. Now, let's keep in mind, this is a screenshot from this morning at 7:30 on the Treasury market. Now, the 10-year inflation, expectations going out 10 years is to be below 1%. And that's the first time since March of 2009. That's a long time ago. And the market is already pricing in another 75 basis point rate cut when the Fed meets next week. Now, if we look at the rates and you take the rate of inflation, the current rate of inflation, we are in real negative rate territory across the board. And the rates being offered in the bonds in the Treasury market, it's basically ZERP. We're in ZERP land, moving into NERP land. That's not really good. That was one of the things, being above NERP was keeping a lot of capital flowing into the US stock market and into treasuries because we were the best kid on the block. It wasn't that things were actually better. It was just that we were the only ones that were actually giving you something back for your money. So look, back in 2008, the financial crisis started with house prices falling, and then you had the derivatives. This crisis started with the coronavirus. And in both cases, it's a debt bubble, i.e., shale and oil, and they got their own debt problems, just as an example. It's not the debt that causes the crisis, it's the pins that pop them. So the derivatives popped the financial crisis back in 2008, 2009. It looks like this pandemic is popping at this time.
Steph,
yeah,
we are, we're doing this interview and we're about 23 minutes, or for 27 minutes into the open. Indices are down. The Dow was down at about 8%. We had markets triggered, circuit breakers triggered. Gold is getting slammed. We're now below $1,600, down 3%. Now the stock market is down a lot more than that. Silver is down about 5%. Again, significantly underperforming. I know we want to go through these things in order here, but it's just crazy to see what we are seeing in this environment. I mean, Bitcoin is getting crushed. We're like at $5,800 now. It's a sell everything moment. It's just, we're seeing pandemonium in our markets. And I want to go through with you the Dow Jones, the S&P 500, and get your thoughts on how significant this can be here in the next little bit as we go through this crash.
Yeah, well, I got the Dow chart live up there, and that's your weekly chart. When we did our interview last week, we were above this lateral red line. And, you know, with the Fibonacci's, that was a 61% retracement off of the all-time high. So right now, we zoom in, we've retraced all the gains on the Dow since Christmas of 2018. That's where we're at right now. And when we look at a percentage basis for today only, we're at 7.2%, and we're down 1,696 points and change. And I don't see it getting any better in the near term, because if you look at the indicators down there, if I have my Schwab account up, I've got all kinds of indicators, a lot more moving averages, but really this is good enough. The 50 exponential moving average is this blue line. It's a very important moving average. You know, we broke through that 2 weeks ago. The channel that we had, the up channel, we broke through that 2 weeks ago. We're down to 2018 Christmas. Notice down here on the bottom, one of these indicators, it looks like an alligator tongue. You know, you got the black thing, that's the ADX, and you got the red up top, the green on the bottom. That's negative trending. The ADX is the power of the trend. It's beginning to rise. But we're already in oversold territory on the Stoke. It's bottoming out down here on the bottom. So that's a good sign. But given that red line on the bottom indicator, it hasn't gotten to the bottom yet. We've got a little bit further to go based on what I'm looking at. And if I flipped over to the S&P 500, you know, it's almost a mirror image with one exception. The indicators at the bottom are the same, but look at the chart. We've only done a 78% Fibonacci retracement off of the all-time high, whereas, you know, the Dow came all the way down here. So the lows that we've put in, we're getting close. We're still around Christmas 2018, but we put in the lows before Christmas of 2018 on the SPY, or I should say the S&P 500. So, and that volume on that weekly, that's killer. A lot of sell volume going on here. It's going to take a little time for it to pick up. So with regards to gold, let's compare. This was as of last night. When we look at all the other indices, gold is acting as a safe haven. The terminology safe haven is misunderstood. A safe haven is not something necessarily that will spike every time there's a crisis. It may spike a lot of times, but not all the time, because you've got all the variables from the whole world to deal with right now and what's going on. Like everything's selling off and you got margin calls and people need cash. But despite this whole disaster, gold is still maintaining its safe haven status. Just recently, I just want to mention that over in London, their trading over there in the gold market is off the charts. They hit some records. That's a big deal. But let's go right to the gold chart. Let's talk about this. We had the same chart up our last interview. This is the daily. I want to zoom out just a little bit more, give you a little more perspective. We are in a bull market. Despite this pullback, we're still within, we're not even close to the channel, which would be right around 1,526 an ounce. If we broke 1,526, I'd be concerned. I'm not concerned. And notice these red lines are the lower trend lines that don't get broken on these, let's call them steps along the way. There's another name for these patterns, but I don't want to get into too many names here. But we haven't even broken that red trend line on this step up. Yeah, it's we're looking at just simply the price. But this was talked about. I wrote about it. I said we were going to go up into the 1620. We're going to hit 1697. 1697 was resistance. After that, the next target was 1733, which is the next fib. And then we got 1,800 bucks. But folks really get stuck with the wiggles. Yeah, this may be a little bit more than a wiggle, but the charts don't lie. It's in a bull market.
Steph, let me just comment on that. And I think a lot of people are thinking this, and that is in the panic when gold is supposed to perform. I think it's confusing that it's crashing on the same day that the stock markets are crashing. And we're not seeing a flight into precious metals. And I know you addressed that last week, but maybe you can reiterate that, as and tie it into what you're saying now. Maybe it's not something we should expect to happen on the days that stocks crash. What should we, or how should we manage our expectations for gold beyond where we are right now?
Well, right now we're hitting the 50-day moving average, the exponential moving average. Let me emphasize that. I don't use the simples. I like exponential. It moves a little faster. It's a little more accurate. Margin calls is one variable that ties into this. It's very important to understand. Back in 2008, we had the same thing going on. Gold was rocketing when the Dow started to collapse, and that went on for a couple of months. And then when people, we had a little bit of blood in the streets, and the markets were really bleeding like they are now, the Dow and the S&P, for instance. People need cash. It's margin calls. And gold is the most liquid asset on the planet, the most recognized asset on the planet as far as liquidity. You can sell it and trade it anywhere. So this is paper gold being sold. I want to emphasize that. These are paper contracts being sold and redeemed for cash. It's not physical gold being sold. Now, that's not to say there ain't somebody out there selling a little bit of their physical, but overall, by a long shot, this is paper being sold to meet liquidity needs, which, like we've said, this is all about liquidity right now. That's what you want. In the meantime, Warren Buffett's sitting around on his pile of cash waiting for the real blood in the streets, because we haven't gotten there yet, to pile in and buy equities, right? That's what he does. So that's what's going on here. And I don't care what chart I bring up, whether it's the indices or the gold or the silver or the Bitcoin, it's obvious volatility is a problem right now. And the machines are having a field day. They are so efficient at this. And it's almost like a virus. I mean, if you think you can control a virus by having your own little algorithm and hitting a button, and you're going to outsmart the rest of the computers and all the algorithms on the planet on an interconnected global system, you're really in fantasy land. That's not how the market works nowadays. It's very different. And that's what we're seeing really high. This is more volatile than it was back in 2008, 2009, really, by a long shot, because the machines have optimized, and corporations and banks, hedge funds have invested heavily in that infrastructure. And I mean, heck, the open cry pits don't exist anymore. There are a couple small ones with very few people that are actually paying to be on that floor, but they're practically non-existent at that point. And by the way, the CME has shut down their trading operations, their floor operations of the ones that are left. And as you can see, everything's still trading, isn't it? Even though there aren't people there.
Steph, let's move over to silver. The question is, does silver have a monetary role? We haven't seen silver do much over the last few years. I mean, considering going back to 2011, it's been a very much a non-event. Gold has performed much, much better. And I know you're going to go through it with us. You know, does silver have more of an industrial role in our world today? And should people take that into consideration when using silver as a crisis hedge?
I don't consider silver a crisis hedge. I do consider gold and treasury as a crisis hedge, but they all have their inflection points, and it's all dependent on a lot of variables. And for silver, one of those variables is a big one, and more than 50% of its industrial, of its use, its consumption, its need, is industrial applications. And the biggest one is electronics and electrical, for instance. But when you see the total supply here, let's go to 2018 and where the industrial fabrication is, it's somewhere north of 50%. So when the world is going through a pandemic, supply chains are breaking down, the economy is slowing down significantly. You've got rolling quarantines, people are hiding at home, businesses are suffering. Base metals haven't been doing too hot to begin with, and that's a commodity. That's the base metals that silver gets put into the basket with. So silver is going to suffer longer, more often, and be more impacted by that variable versus gold, because gold doesn't have that kind of variable with industrial use. It's very small. I don't even know what the percentage is on it. But as back in the financial crisis, and when gold and silver had their run, gold took off first, then silver followed, no matter what was going on with the financial crisis. Finally, it took on its monetary value after it took out 2149. For some reason, I don't know why that number is important. It's just what the charts say. Like, I'm sure we got a dozen reasons we could come up with. And then it outperformed and hit its high 6 months before gold did, and went down a lot quicker. Gold chopped for almost a year and a half before it fell in 2013. And it fell in 2013 on the same week that all of the smart money flowed back into the stock markets, because the stock markets finally broke out of an overhead resistance level that took 13 years to break out from, and the Fed was backing everybody up. We got you back. Forget it. We don't need a safe haven like precious metals, for instance. So that's why the stock market took off. We had all the QE, and gold took a hit. And the machines at that time, riding on the coattails, everybody had a good time going short. So let's look at the silver chart. Pretty sure I got that up. Just give me a second. All right. I'm going to get rid of this list on the side so we got some more room. So last week when we did our piece, my internet connection is unstable. You can see where we were back in 2018 through 19. We put in a double bottom. We bounced, we ran up, and we put in a high. We have a trend line there. Which is from where the run we had back in 2015 through 2016, right? Kind of looks like a flag. It's a little bit long in the tooth for me to consider it a flag. Now it's more like a channel. It's a down channel. But even as we speak right now, I'm going to zoom in. If if I get real particular about where the points on that line, we're pretty much sitting on that lower line. My biggest concern on silver was taking out that lower line. So silver is below 16 bucks an ounce. It's been as high as just shy of 19 most recently, within the last 6 to 8 months. And that's where it's at, you know. But this price point for stackers who are building core positions, lower price points like this is a steal. It can't hurt to add to core positions at these levels. But you have to keep in mind, I don't think you're really going to see any fireworks until that 21.5 is taken out. You know? And I'm probably beating a dead horse about that. But it's the truth. That's where we're at.
Silver is then, in your opinion, a steal right now.
Yeah.
Steph, what do you believe is the potential for silver? Again, going back to its role, you know, why people own it. I mean, if it's so tied to the economy and we have a negative outlook on what is coming, you know, why own it? Why not just own gold?
The lower price point, because you can buy more of it. Gold's a lot more expensive.
So let's talk a little bit about that. You know, gold we've hit 100-to-1 ratio on the gold silver ratio. I mean, and this is something that we were talking about pre-interview here. Does it even mean anything anymore? Or is it just, it's just analytics? You know, I know people who like to point to that, they like to trade off of that, but I mean, we're getting to a point now where, you know, we've been talking about the gold silver ratio for a very long time, and it's largely meaningless. I know this is something that you've addressed a number of times. So maybe take us through that.
Yeah, I got a little video clip that I'll play to spare you me just talking and talking and talking. But yeah, I wrote this article back in July 2019, and I addressed what this gold to silver ratio was, what it's about, and why you should pay attention to it and why you shouldn't pay attention to it. But you shouldn't make a trading decision or, you know, a specific point in time decision on your purchases based on the gold to silver ratio. It really doesn't give you that information. And we're going to let Logo Tigre, I think I'm pronouncing his name right, he's going to opine on this for about a minute and a half. So let's hear what he's got to say.
Talk about the gold-silver ratio, since many of my guests depend on it religiously to determine, you know, where silver or gold might be headed. But you say throw that out the window.
Yes, I did. I've written about this before, and you asked about what have we learned in 10 years. I've looked at the gold-silver ratio since I started in this business 15 years ago, and I have found basically zero predictive power in the GSR. The gold-silver ratio being out of whack tells you that it's out of whack. It doesn't say it can't get more out of whack, and it doesn't tell you which metal will go up, right? The gold-silver ratio can close by gold dropping just as easily as silver rising, right? So I have looked at it in many ways. I've thrown plenty of math at it. I have not been able to find a way to use the gold-silver ratio to predict which metal will go up. But what we do know is that it does tend to normalize. So if you're bullish on gold, coming back to what I said before, and the gold-silver ratio normalizes, then silver has to do better than gold.
All right, fair.
So that pretty much sums it up, and that's why we're back to over 100 on the ratio, where, you know, I think just recently it was down in the 80s somewhere, and I think when I wrote this it was in the 90s maybe. And now, you know, the price point is back where it was in silver. If I bring up that silver chart, I'm pretty sure it is. What's the date on that article? That was July of 2019. And if we go to the chart and look at July of 2019, the price was at down here. It was down in the 15s. It was on the 15 handle, somewhere between 15 and 16. and the gold to silver ratio was a lot lower. Now we're in the same price range and we're above 100. So you see, I think the chart, just looking at the silver chart is where you should base your decisions. For low risk, high reward entries, and keep in mind, buying silver and trading paper or buying paper core positions in some form of ETF, silver ETF, whichever one you choose, is very different. You wouldn't be buying silver at the same time you'd be trading paper, you know? Maybe if you were taking a core position in paper, just like you were taking a core position in physical silver, the timing may be the same. But there's so many variables here and everyone's trading style is different, and then you have goals. So yeah, I think that sums it up for the gold silver ratio.
Steph, let's move over to the last topic for discussion, and that's Bitcoin. And full disclosure for people listening, you know, you haven't been Bitcoin's biggest fan. So, you know, I want to put that out there, but I want you to touch on the charts, you know, not from a biased perspective one way or another, but what we're seeing right now as Bitcoin is crashing with the rest of the markets.
Yeah, you know, my point of view is divergent, like a chart, you know, and that's what we got right now. When you actually look, I'm going to do the comparison, but the gold and silver price since sometime last year have diverged, whereas Bitcoin just keeps going down, but the gold price actually went up and is still up. So that's a divergent. And my divergence is I'm okay with it as a speculative vehicle. But as far as any safe haven value at this point, and being something that's going to be widely adopted by the population across the globe, like the current monetary regime is, you know, accessibility, liquidity, blah, blah, blah. I don't see that happening yet. I see maybe a price spike in Bitcoin when, and I think we talked about this last year or so. I said, ETF, wait for the ETF to be approved. Then you're going to see some crazy paper trading in the Bitcoin space where every retail investor is not going to be all confused about, you know, well, which crypto platform I need to be on and what are the rules? And, you know, it's kind of complicated to learn, you know, quite frankly. But if you got an ETF on the stock market that, you know, you can invest in like anything else that you're invested in your portfolio, hey, a lot more money is going to flow into that space. So I like that speculative aspect to it. So when we look at the charts, I did these charts when it began its run, and there's a link over on my website. It's got all those charts going back to 2015, I think it was. These volume spikes back here is where it broke out, and I charted this whole run. And when we got up here, I'm like, you know what? I didn't recommend buying at a high price point like that. But if you were fortunate enough to buy way down here or somewhere along this accumulation phase, just like occurred in gold, for instance, might have been some time to take some profit off the table and just like wait and see what happens. So it fell. And I got that 2018 dead cat bounce double top lateral line there for a reason, because when Bitcoin fell in 2017, December, January, thereabouts, the first low it put in, it went through the 50, but it didn't close through the 50, and then it bounced. That was the first dead cat bounce. And this went on for weeks. It just couldn't get through this level. And then it fell again. It chopped out. I got it marked what they're called. So that level is really important. That's roughly around 12K. And my thinking has always been, look, if you really believe Bitcoin's going to go through the roof and break 20K, waiting for a low risk, high reward setup, even for a core position, it can't hurt to wait till 12. Because, I mean, even the move between 12 and 20 is a nice chunk. And if it goes beyond 20, you're golden. If you're just going to fight over a few thousand here and there, you know, you're really sweating bullets for, you shouldn't be sweating bullets. You don't want to sweat bullets in an investment, right? You want low risk, high reward. So that's just my line of thinking. And as you can see what's going on, every time we get a run, you know, you get screaming buy now, last chance. And I can't tell you how many times I've heard it since 2018, and it just gets really old. And that's okay. That's human nature. It's like that in the gold and silver space at times too, you know. But we're in a bear market. We haven't even taken out the 2017 trend line, and that trend is starting to steepen to the downside. If we take out this level right here, we're at the same lateral where we were at the lower trend line of that descending triangle back in 2018. If we take that out, we're probably going to revisit this bucket down here. And there's not much resistance because you want to go to the most recent buying that occurred, and that's this right here. And you know, there was some buying, but nothing like we had back here on the initial run, as well as in the chop in 2018. It's really pathetic volume. And if this breaks, it'll be a quick trip. It'll happen quickly, just as it happened back here. That's just my guess. And looking at the studies on the bottom, we're just starting to get that look. You know, it's like an alligator tongue coming out, where we're trending out over to the negative, to the downside, where the red line's above the green line and the black line's coming up underneath. But the other one is saying it's oversold, but that red line hasn't gotten to the bottom yet. So I think there's more downside, and then it's going to chop. And if I flip back to the gold chart, that's the same thinking I've got on that particular indicator. Let me bring it up real quick. And just as a reminder, I'm going to throw up that weekly. Okay, I think everyone can see it now. So let me give it a second to settle down, make sure everybody can see it. Notice that bottom indicator, it's already down at the bottom. It could stay there for a while just as well, but that red line hasn't rolled over and went down with it. So there's going to be more, not necessarily more of a correction here. Could. We got some support as talked about earlier, but more chop than anything. And I put that out there back in December and January, that once we got up at that space between 1620, 1697, there would be chop. I think the same thing's going to happen with Bitcoin. It'll probably trend lower, and then you're going to get into some chop, and then you have to, you know, think about, well, what you're going to do there. So that's my view on Bitcoin alone. But I want to address one more thing with regard to a safe haven status. And I pointed out that there was this divergence. So here on the monthly chart, you can see that, particularly right here. Look, Bitcoin, it's got its advantages as a speculative asset. Some of those moves are just incredible in both directions. It's really volatile right now. And that's one of the reasons I shy away from it as a safe haven. It's just not stable enough for me yet. But look at this divergence where the gold price is going up, but Bitcoin is going down. And we can take that into consideration since about June, when gold started its most recent rally and blew through 1380, which we talked about and wrote about. So until this divergence rectifies itself, Bitcoin's not holding up as a safe haven because it's in a bear market, but gold is still in a bull market. And that's my point of view. And the charts have shown that to be the case. So, but everything's going to turn around at some point. Everything does. Blood in the streets is a really tough pill to swallow, particularly when you've seen it coming.
Steph, what a powerful interview, and thank you for this timely update. I'm going to get this up as soon as possible. TraderStef, everyone, visit her work at crushthestreet.com. Steph, thank you so much for coming on and doing this. And who knows, we might be doing another one here in very short order. So thank you so much for pouring into all of us and all the work that you do.
Hey, Ken, thanks for having me on. And everybody be safe out there. Keep your hands clean. Keep them out of your mouth. Be aware. It's the real deal.